Today I would like to analyze Disney, one of the largest entertainment companies in the world. The stock price is down around 36% from the highs in 2021. So we also had some recovery already from 2023. We are up around 49%. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 212.83 billion US dollar. We can see here this makes Disney the second largest entertainment company in the world by the market cap. We also have a dividend yield of around 0.84%, which we can see here was very inconsistent in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 65 billion US dollar. This was a decline around 6% from 2019, so probably related to COVID. Then in 2021, we saw the decent growth around 3%. In 2022, we saw the very good growth around 22%. In 2023, we saw the good growth around 7%. And then in 2024, again, the decent growth around 2.7%. So I would say in the last 5 years, we had a good revenue growth. So is a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 3.6 billion US dollar, with an incredible growth around 107% from 2019. Then in 2021, we saw the decline around 44%. This is something we don't like to see. Then again in 2022, it declined around 46%. And then we had a strong recovery in 2023 with a growth around 358%. And then again, incredible growth in 2024 with 74% growth. So overall, I think the free cash flow was very inconsistent. The reason for that is as well this company investing huge amount into the business, into new films. I think it's more interesting to see the operating cash flow actually. And here we can see the 15% growth in 2020. Then they decline around 26% in 2021. The good growth around 8% in 2022. The very good growth around 64% in 2023. And the very good growth again around 41% in 2024. And I think overall this is something positive. This business is still growing, and I think it's a check here in the free cash flow growth. We like to see that. The next thing we're looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for an undervaluation. So we're going to take the free cash flow from 2024, 8.56 billion. We're going to divide it with the current market cap, 212.83 billion, and then we're going to get the free cash flow yield that we're looking for. This is around 4.02%, and I think that's a decent free cash flow yield. It's over the 4% that we are looking for, so it's a check here. But I think it's an indication for a fair valuation and not an undervaluation right now. We can also take a look at the future assumptions of the free cash flow. In 2025, around 8.5 billion. In 2026, around 9 billion. And 2027, around 11 billion. So let's assume for 2027, around 11 billion. I'm not sure if they can actually reach this number. So let's take the 11 billion, divided with the current market cap, 212.83 billion. And then we're going to get a different free cash flow yield. So the number we're going to get would be around 5.16%. And I think it's a good free cash flow yield. It's over the 4%, and 5% is a decent amount, I would say. So it could be an indication for fair valuation or slightly an undervaluation right now. So it also would be a check for 2027. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. So we can see here 2024 around 38.97 billion. Then we're also going to add the short-term debt. So we can see here actually the short-term debt is around 6.85 billion. And then we're going to divide this number with the current free cash flow, and this is around 8.56 billion. So then we're going to get the ratio that we're looking for. So the number we're going to get would be around 5.35. And I think it's not a very good number. It's over the 5 that we're looking for, so it's not a check here. And it means in around 5 years, we can repay the debt with the free cash flow. So it's not very good, I think. We can also take a look at the cash on hand, and we can see here they have around 6 billion US dollar in the bank. I think it's also not very a big amount. The only positive I would say about the balance sheet is if we take a look here that the debt was way higher in 2020. It was around 62 billion. And now in 2024 is around 49 billion. So they're trying to pay back the debt, and this is a positive, but overall I think they not have a very good balance sheet right now. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the ratio gets, the higher the indication for an undervaluation. So first you're going to calculate the enterprise valuation. So this is the current market cap, 212.83 billion. Then we're going to add the debt. This is around 45.82 billion minus the cash, 6 billion. And then we're going to get the enterprise valuation. So how much the whole company is worth. So the number we're going to get would be around 252.65. So now we're going to divide this number with the current free cash flow, 8.56 billion. And then we're going to get the ratio that we're looking for. So the number we're going to get would be around 29.51. And I think it's not a good number actually. It's over the 25 that we're looking for. So it's not a check here. And for me, it's already an indication for overvaluation right now. We can also calculate this number with the free cash flow assumptions for 2027. So with the 11 billion. Then we're going to get a different ratio. So the number we're going to get would be around 22.96. And that's a better number. It's under the 25 that we're looking for. So it would be a check here. But for me, it would be an indication for fair valuation, but only if they can reach the 11 billion in 2027. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that especially if we think the company is undervalued. So we're going to take a look here, and we can see it's very interesting because they did buy back a lot of their shares in 2027, around 5%. But then also many years, 2019, they increased the shares outstanding, 2023. Yeah, so they had some buybacks in 2025 and 2024. But again, also many years they increased the shares outstanding. So overall, I would say it's not a check here, and we don't really like to see that. But I think it's also understandable because the balance sheet is not looking so good right now. So I think they should use not the money to buy back their own shares. They should use the money to pay back their debt. And they're doing this as well. So overall, I think it's understandable that they not invest a lot of money to buy back their shares right now. Can Disney stock be a good buy right now? The stock price is down around 38% from the highs in 2021. In the last few months, we had a good performance and are up around 39%. So let's start with the positive about this company. I think we had a decent revenue growth in the last 5 years. I also think we had a good free cash flow growth as well. So that's something positive that we like to see. The balance sheet is not looking very good actually. So we have a high amount of debt and the cash amount is quite low. The free cash flow yield around 4.02% is quite decent in my opinion, and in 2027 it would look slightly better with a free cash flow yield around 5.16% with our free cash flow assumptions. The enterprise valuation to free cash flow ratio is around 29.51. This is not very good in my opinion. We want to see that number under 25, and in 2027 it would be under 25 with around 22.96 ratio. So this would look slightly better, and it could be considered a fair valuation, but only if they can reach the 11 billion in free cash flow. What I don't really like about this company is the shares buyback. I think they don't really have the financial to buy back a lot of their shares, and the dividend yield of around 0.84% is also not very high. So overall, I not think very positive about this company. I think the financials not look very great, and I also see in other companies more potential at the moment. If you found this video helpful, don't forget to like and comment and subscribe for more content.